Hello and welcome to Switzer Investing. I'm Peter Switzer, and on this show I get local fund manager with an overseas focus, Charlie Aitken of Aitken Investment Management, to name his top stocks in his portfolio. And he gives us a very strong argument to buy Microsoft. And he names what local stocks he would buy if his fund was locally focused. And then Gemma Dale of NAB Trade, who has access to all of the trading data on the broker platform, and she's coming on the program and she'll tell us what companies are hot and those that are not when it comes to what people are actually buying right now. And finally, for investors who want 5% plus income in a world where term deposits won't even pay 1%, Paul Rickard looks at the products on the stock market that might help you get 5% or more. So without any further ado, let's cross to Charlie Aitken.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, we historically focus on local stocks, but Charlie Aitken's come along today, and Charlie runs a fund that has a big emphasis on foreign stocks. And I want to talk to him about the top 3 stocks in his fund and why he likes them so much. I know one of them is Microsoft, right, Charlie?
Yeah, I mean, I think we go back one step, Pete. I mean, global stocks are simply complementary to an Australian portfolio.
Yeah.
I'm not sitting here saying people should not be in Australian stocks,
right,
but they're complementary. They offer sectors and exposure that you simply can't get in Australia, and also much bigger marketplaces, etc.
Yeah.
So I think you should look at it as complementary to Australian stocks, not instead of Australian stocks.
Yeah, well, financial advisors put their clients in both foreign and local stocks. It gives you diversification. And there was a period, I think the 10 years before the GFC, Australian stock market did better than the US market.
Yeah, absolutely.
Because of the dot-com bust and all that sort of stuff. Yeah. But the next 10 years, the Americans did better. So being diversified is really sensible. Now, but I know you've always been a big fan of Microsoft, and when you've come on this program over the last 3-4 years, you've always talked about how you like Microsoft. And it's continually done very well. We might even get the chart put up as well.
Been a great stock.
So why is Microsoft so good, and do you still like it?
Yeah, it looks a fantastic stock. Obviously had its third quarter result the other day. Classic example of a stock you cannot buy in Australia.
Yeah.
The leverage to the themes it has, and also the operating position it has. But you think about it, it owns Office 365, the world's premier operating system. It owns Azure, which is a cloud storage business. It owns LinkedIn. It owns Xbox. It owns the variety of the greatest businesses on earth.
Yeah.
If you look at the third quarter result, after PCP versus last year, revenues of this 1.8 trillion market cap company up 19%. Profit up 33%, margins are exceptional at 69% at the gross level, return on invested capital of 44%. It still grew EPS at about 40%. It bought back $10 billion worth of shares in the quarter. And this is just a giant business that's still growing at about 4 or 5 times GDP, mainly driven by cloud storage and the operating system known as Microsoft
Charlie,
365.
was it helped because of coronavirus that more people were working from home, that they use more Microsoft or not?
Perhaps a little bit,
yeah.
But
they would have done it in the office anyway, wouldn't they?
These trends have been going on for 10, 15 years. They got a bit accelerated by COVID, there's no doubt. But I think they continue because not everyone is actually coming back to the office. People are doing 3 days a week. Yeah. You're still going to have that remote option as a backup. Yeah. Things like LinkedIn grew at 25% as well. Teams, Microsoft Teams grew at 30, 40%. Yeah. So it's basically got a finger in all these structurally growing pies, but even better, it's the world leader in everything it does. And so I always worry in tech if there's going to be competition, Pete. Yeah. See, I remember last time I was on the show, I'm a bit worried about buy now, pay later. I think it's quite easy to competition to come there. Yeah. Electric vehicles, well, every traditional vehicle maker's now switching to electric vehicles.
So the moats are more attackable.
They're attackable, probably less barriers to entry. Microsoft, the barriers to entry are truly enormous. And I think that it justifies it, and the returns it generates of, say, a 44% return on invested capital are justified by the moat. Very hard to attack.
Does it worry you that Bill Gates and Melinda are splitting up, mate?
Oh, not in the slightest. I think this is business being run for 14
I was just joking.
Look, I mean, it's not perfect, some of that stuff, but it's irrelevant really to what our view is on the share price.
I saw a very interesting interview with the CEO of Microsoft. My pronunciation, Satya Nadella.
Yeah, not an easy one, but he's been 14 years. He's done a wonderful job.
Well, in actual fact, the graph started going up when he took over.
Correct.
Though I would say I interviewed Steve Ballmer here before he took over, and Ballmer did say our future is going to be cloud, and no one knew what cloud was.
What does that mean?
So he knew where it was going to, and he's done very well as a major shareholder, I suspect. But what he said was, which intrigued me, he said, Microsoft Teams is going to be a very important part of their business model. And a lot of people thought, oh, well, once we go back away from coronavirus, it won't be important. He's basically saying all businesses will be incorporating Microsoft Teams, and therefore probably Zoom as well, in their business models, because a lot of businesses won't fly as much anymore, and they'll communicate with the workers at home.
You also need it as a redundancy if things like what happened in Victoria today continue to happen around the world, if there's just flare-ups of COVID. You need that redundancy that your staff can work from home. Teams is a very, very good product. I mean, we use it. We don't use it every day in the office, but we do have it as redundancy. And the other thing with Microsoft that you forget, there's about 80% of their revenue is unearned. It's just people like us renewing our subscriptions. They're not selling us new products, and they just put the price up.
And don't we review the alternatives to Microsoft 360?
Well, what are you going to use? You would have used Word today. You would have used PowerPoint today. You would have used Outlook today. You use LinkedIn today. Probably.
They got the claws into us.
No, they do, and that is why it is our second biggest investment.
Okay,
it's
that's
a truly wonderful.
Okay, you've proved the case at Microsoft, and I say, I do think this is a company of the future still, even though it's been around for a long time, because we're going to keep on using it. What's the second one in your fund that you think?
Well, our biggest investment's Alphabet. I think I talked about the parent company of Google. I talked about last time.
There's another company's got the claws into us. Really, as soon as we wake up, go to Google.
How are they going to get challenged in search, and how are they getting challenged in YouTube? They're two biggest businesses. YouTube, we watched on today, is a wonderful business. It's competing with free-to-air TV. It's competing with streaming. It's a new game.
If you put your YouTube app on your television at home, the big screen TV at home, you can watch the Switzer program on a big screen like that.
You can watch it 24/7 if you're that keen.
On a repeat loop.
Repeat. You're right though. It happens at our. I mean, I've watched my children use YouTube at home, also to actually research, some sort of homework projects as well. But YouTube is a wonderful business with wonderful margins, scalability. But search, in terms of just looking things up on the internet, I think it's unchallenged. Wonderful margins, advertising revenue from that. But also, as the economy reopens, there's more and more searching being done for products, but also search engine optimization. Businesses want to be top of that page, and they'll pay for it. So look, that is a truly wonderful business, not expensive, sort of 27 times.
And there's no real rival coming out of the woods.
I don't think so.
That's going to beat that moat.
I don't think so. I find that hard to see coming. Growing revenue again at 20%. The point I'm trying to make here, Pete, you don't have to go outside of two of the world's biggest companies to find 20% revenue growth, huge returns on invested capital between 40 and 50%, huge operating margins, huge free cash flow. I mean, Microsoft generated 17 billion of free cash flow in the quarter, massive number, huge buyback programs, and wonderful, wonderful balance sheets. These companies have between 50 and 150 billion of net cash on their balance sheets. So the one thing that's helped us a lot in the downturn last year was these businesses, with the cash on their balance sheets, makes them so strong that they never fell as much as everything else. And plus, people need them in day-to-day life.
Okay, third one.
It's actually Berkshire Hathaway. Warren Buffett's company, because we think that just gives us wonderful sort of broad exposure to the recovering cyclical American market. Deep manufacturing businesses, Burlington North Santa Fe Railway, utility businesses, everything cyclical you could think of, Geico and car insurance company. Investment portfolio with a trillion or whatever it is of Apple. It's got, to me, Berkshire Hathaway with a balance sheet of 150 billion cash, and irrespective of the age of Munger and Buffett, is basically like an exchange traded fund over industrial America. Think of it like that. You don't have to pick a stock that's just one American industrial stock. Berkshire gives you a bit of everything, like an ETF, but a super high quality ETF. So only things we'll own, Pete, and that's where people get mixed up a bit, is so if you just own the best things, you don't have to worry too much. You really don't. If you're an investor and you just pick the very best business in each sector, be it Microsoft, Alphabet, Berkshire Hathaway. You can sleep at night, the volatility of your portfolio is lower, but your returns are no lower.
Okay, so how many stocks do you have in your fund?
22.
Okay, so what's number 4?
I'm 4 at the moment. I think we've got to go through the whole thing.
Well,
no, it's fine. I like doing this because that's what we do.
It's great that you diversify.
Yeah.
Berkshire Hathaway is very different from the tech stocks. Now,
Number 4 is one of my old favourites that we've spoken on this show many times, Louis Vuitton and Moët Hennessy.
Yeah, so that's another example of what you said.
The world's luxury leader. Again, it's a bit like an ETF over luxury. If you think about the brands they own, they're in alcohol, they're in fashion, they're in leather, they're in jewellery now with Tiffany, they're in everything high-end.
Don't they own 2XU as well?
Oh, I believe it. Maybe. I don't know the answer to that.
I
don't know the answer to that because it's not
they
one of the major.
They bought RM Williams, but then sold it.
Well, that's actually inside a private equity thing that they do actually. But look, the main thing's fashion and leather goods, followed by alcohol, and this big bet on Tiffany's. I think that'll work too. I mean, it's just been a wonderfully run company, and with people not travelling, but house prices going up, the share market going up, people are buying themselves gifts like handbags and new shoes and bottles of Dom Perignon because they can't travel. All this money they're saving on travelling. So it's been actually a pretty big winner of borders being closed, which would not have, most people wouldn't have thought of me, but I think that is a wonderful company. And our 5th biggest investment's PayPal.
Okay, now
PayPal is another great one. So
there's 5.
There's 5. That's our whole portfolio.
Okay, but I think I want to make this point that you actually did make your name being a commentator on local stocks.
Yep.
That was when you were at Bell Potter.
Yep.
And did you have the same attitude to investing then? Because you used to come up with ideas all the time, and it wasn't quite the same theme that you've carried into your fund.
I think I always tried to think global, act local when I was writing strategy, back in the broking days.
Yeah.
Try and take global themes and see if you could act locally. The problem with that was there wasn't enough depth in the local market to really run with those themes.
Because tech wasn't as big.
Well, not even tech. Well, if you wanted to play tech, what did you do? You probably could own some Xero, and that was about it in the olden days. If I wanted to buy luxury goods, I had no option. If I wanted to buy American industrials, I could probably buy Brambles. It was a very narrow market, very narrow market. It was really just banks, resources. So I thought that we could bring those global themes to Australia, but also package it up in a portfolio of just really great businesses. So we don't own any banks and resources because we think anyone who invests with us has got enough banks and resources. They've got Australian banks and resources. So we try to complement what people have here without in any way thinking that Australian opportunities aren't good. Pete, I always said on writing for you and writing for myself, Australia for income, global for growth. And I still absolutely believe in that. You can harvest good income in Australia due to the monopoly and duopolies, monopoly industry structures here, plus the lack of ability to reinvest. Whereas globally, the growth option is always there.
Okay.
So look, it hasn't really changed my view. I just think you look globally, but we now act globally. But it doesn't mean that we're not interested in any way in Australian shares.
Let me throw a curveball at you because that's our whole relationship's always been curveballs. If you were forced to become a local fund manager, using the same investment approach that you're talking about that brings you to Microsoft and stuff, well, let's say 2 Aussie companies that you would definitely have in that portfolio. I think I know one of them, but I'm not going to tell you what you think.
I'd say one is CSL, absolutely.
That's
There's
exactly what I thought.
no doubt in my mind that CSL.
It's world class.
If hypothetically we had an Australian stock, our biggest holding would be the Commonwealth Serum Laboratory, if you want to call it that. No doubt in my mind. World leader in what it does. Wonderful investment metrics, wonderful returns on capital, wonderful balance sheet, wonderful management. That's what we look for.
Okay.
Great business.
Okay.
Second one might actually be Macquarie Group.
Yeah.
World leader in what it does, one of the world's biggest asset managers. Great people, great management, great balance sheet, great positioning. We don't own banks as such. I see it as a fund manager.
There's an investment bank as well.
Yeah, a little bit of that, but it's more of an asset. I think they're really smart people. So if I had to, if we hypothetically own them, CSL and Macquarie.
Would Xero get in there, do you reckon?
Maybe, but not at the same weighting. Not at the same weighting. Because it's riskier.
It's enough income,
it's riskier, it's more expensive. There could be some competition there, but yes, it potentially would. So look, I mean, there's a case for having a fund that does Australian quality. But think about the 3 that we mentioned. CSL, Macquarie, Xero. Global marketplace. Not just the 25 million that are Australian population. Exactly. If you want a bit of growth, you've got to have that global angle. So CSL, Macquarie, Xero do have that, obviously. So look, I mean, there's great opportunities in Australia too. I think personally, Pete, I think interest rates are going to stay low for a very long time. I think the alternative in cash is going to be, take you backwards in real terms. I think there's there's every reason to remain fully invested in great businesses.
Well, when you made the point earlier where you say overseas for growth and Australia for income, that's why we started the Switzer Dividend Growth Fund, to go for income.
So
Charlie
you
Aitken.
can have a bit of AIM and a bit of Switzer. Thanks, mate.
Well, that's Charlie Aitken of Aitken Investment Management, or AIM. Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Well, joining us now is Gemma Dale from NAB Trade, and I want to ask you a title because it's one ridiculously long title, isn't it?
Yeah.
Okay. Okay. But the more important thing is that the Gemma looks at what trading's going on and she tells us all about the themes. So what are we seeing?
It's quite quiet at the moment. That's probably the most important thing, or the most telling thing at the moment, is a lot of investors have gone to the sidelines. They feel that 7,000 mark for the ASX 200. Feels a bit toppy, makes people feel a little bit uncomfortable. And we also have a heap of investors who did so well last year, making 1,000% on Afterpay and all of these other stocks. They've just done unbelievably well. Yeah. It feels like a really boring flat market for them. They're not seeing the exciting opportunities. The one thing we've seen, in addition to the market going quite quiet and not seeing the same aggressive buying we saw last year, is cash levels are really high at the moment. So we saw the same thing at the beginning of last year. Leading up to February last year, our cash book got higher and higher and higher and higher. People just hoarding cash, waiting for an opportunity.
So have they taken profit? Have they sold and therefore they're sitting on the cash, or are they adding cash?
They're mostly adding cash. So we do see a bit of trimming here and there for certain things. So what we're seeing at the moment in terms of trimming, we're seeing trimming in the banks. A lot of buying in the banks around the $14, $16 mark last year, excluding CBA. Obviously didn't get down that low. CBA has been the one they've been trimming, interestingly, so it's at absolute
pretty
highs.
high.
It's amazing. So we've got plenty of people who are going, that is fantastic, nearly $100. I'm very happy to trim at this level. And the others, they've done very well out of them. They're happy to take a bit of money off the table. So they've been trimmed a bit. And then anything that people have bought because it's been absolutely hammered and it's had a bounce, they're quite quick trades at the moment. Kogan's a really good example. So it got absolutely hammered last week. Inventory's rising, things are not looking great. This assumption that all of that pandemic buying that they saw last year was going to continue obviously hasn't come through as strongly as they hoped. A lot of investors saw the price fall well below $11, quite liked getting on that, in the sort of $8, $9 range. That's at its lows over the last 12 months anyway. It's had a great year. Jumped in, price bounces 15% the next day, they're out. They're not hanging on to that.
Real traders. Are you starting to see at this point some end of financial year selling, people materialising their losses, and maybe we'll turn around and buy in July?
Yeah, it's a really good question. I don't think we're seeing it strongly at the moment. As I said,
we've got time.
Yeah, there's another month for that to happen. We will see it absolutely happening the last 2 weeks of June. And where people have losses, so a couple of places where we've seen some trimming. One's Afterpay, which is very interesting. Afterpay is really funny, right? Our average buy price last year was $40. So that's across our entire base. $40 they were buying. It's up sort of $90 to $100 depending on your day at the moment, but people remember it got to 160. So they're going, I missed the highs. I haven't done that well out of Afterpay. You're like, look, you've more than doubled your money. You've done very, very well on average. And yet quite a few people feel that it might be time to get out of that they may never see the highs again that it got to. So we've seen some trimming in that. Because we did see buying at 120 and 140, there will be some people who've got losses in there, so that may be driving some of the sells.
I wonder if some young investors don't realise that they will pay tax on their profits as well.
Oh, you would be amazed how many people ask the question, how do I not pay tax?
Yeah, funny that.
Going to have to, I'm afraid.
Okay, so we'll watch that over coming weeks. What have been the stocks that have been popular in the last week or so?
It's been quite interesting. Anything that gets hit really hard becomes popular. So EML Payments got absolutely hammered. Irish regulatory concerns, a lot of aggressive buying.
Well, about 15% the day after it went down 40%, wasn't it? Yeah.
So there was a lot of buying there. It seems to be only really aggressive buying when someone gets hurt a lot. It needs to be really aggressive. A2 Milk, for example, it's had four downgrades.
Yeah.
First couple of downgrades, people were all over it. Next 2 downgrades, they're like, do you know what? I've had my opportunity to buy.
And that's a stock,
Gemma,
that could easily have a lot of tax loss selling over this month because they've lost, and they'll probably buy back again at low levels, hoping that their fortunes will be turning around. Hopefully, when Chinese tourists come back, which could be still some time.
It could be some time. I think a lot of our guys will stay on the sidelines when they've been burnt by something. Often they will go to the sidelines on that stock, and it takes a lot of good news for them to be enthusiastic about coming back. One that's been really interesting is CSL. So we've seen trimming in CSL this last couple of days because it's doing really well, relatively speaking. CSL's highs are at $350, not 150. Wow, 350, right? Yeah. It was down at 250 just a couple of months ago. Investors who remember that 350 high and also know that 250 was the COVID low for CSL were all over it. They were loving it. There was so much.
You make $40 on 250. It's a nice return.
Doing really well. But they're trimming now, so they're not waiting for it to get to 310, which was again only a few months ago, or back to its highs of 350. They're quite happy to trim at this level, which I find really interesting.
What's happening to the classic reopening stocks? The Qantas's, Webjet, Flight Centre. They've had some runs, and I think the runs were well ahead of time. There's been a bit of a pullback. Is that pullback still going on, or are people buying on the dips?
They buy them on the dip. So when you get some news, if there's a COVID outbreak and everything gets sold off, people will perhaps take a little bite at them, a bit of a nibble. When Qantas said that they were going to be cutting their payments, their commission payments, Webjet got hit pretty hard, and so did Flight Centres. People grabbed them then, but they had a big year. They were those 3 stocks were in our top 10 last year for buys. That would never happen in any other period, right? So people were very opportunistic about them. They don't need more of them. They don't need more travel stocks. They've got a lot. I think that they'll mostly sort of let them run here. Okay,
so we've talked about rotation in the past, and we are rotating out of the stay-at-home stocks for the reopening stocks. If you have to name one stock that you think your fraternity, the NAB Trade fraternity, really is going to like as it runs down the next 6 months or so, what stock would? It's probably the one you bought for your own personal portfolio after watching this stuff.
It might be. The two that we're seeing the most interest in at the moment. So the one that just has come to the fore in the last couple of months and is not dropping away is Fortescue. It's not a reopening story, it's got nothing to do with reopening, but Fortescue, because of the iron ore price, has been, and it's a pure play, so Rio Tinto and BHP just don't get the same attention. Fortescue last week was 3 times more traded than any other stock. So to say that our guys are into it is not an understatement. Right. They are very seriously into it. They love it. So that's quite interesting, and it will take a fairly serious fall in the iron ore price to get them trimming that. That'll be really interesting. CSL is the other one. So they're the 2 that have not come from nowhere, but were not in our top 10 last year, that are right back up there now.
Okay. On Monday's show, I actually pointed out that 3 stocks that I looked at, which I called AAA stocks, have started to rise. Altium, Appen, and even A2. And they all rose by a similar amount in the same week. And it just seems to me that we might be getting close to a turning point. But one stock I left out because it wasn't an A sounding a name was Nuix. Now Nuix was massive, was sold off. Are you seeing people buying Nuix on the dip, or are they a bit afraid of Nuix?
So it's a really good question. You mentioned Appen. It's been quite popular the last sort of month or so. I mean, the wax stocks are down like 50% over 12 months, which is incredible when you consider the run they had leading up to COVID. They were so popular, everyone was talking about them. They got absolutely hammered. Afterpay obviously fell to such a low, it's come back incredibly strongly, but it's been all over the show. So Appen's been very popular lately, which it wasn't for the last sort of 2 years. Nuix is really interesting. We have seen some buying. It's not been as aggressive as you might imagine. People are a little bit concerned about the press about it. It doesn't have the track record of some of the others that they are familiar with. They know the highs. It started at a high and has pretty much fallen away in a straight line. So for people, there's a real concern about that. It doesn't have that same appetite.
All right, so last question. I've often said that when a stock has been belted up, I like to see it form a base, and maybe I might miss out in the first 5 or 6%, but once I see that trend going, that's the time to get in. Do you think that the NAB trade investors are of that kind of mentality? Because they seem to be, when the trend's there, they get onto it, but they wait for the trend to actually show them a good reason to get in.
Our guys are surprisingly well informed, and I say surprisingly because I hear from fund managers all the time, God, they move so quickly.
Well, we do put a lot of education into those investors as well.
You do.
You do too.
They move quickly, and that surprises a lot of professional investors who do a lot of research, and they take time, and they will put multiple trades in to build up a position. They are astonished by how quickly retail investors move, and they do move very quickly. Retail investors last year moved much quicker than professionals when the market started to fall. And the market fell so quickly and bounced so quickly, they did better, right? They did incredibly well. So yes, they like to see a base, but what's most interesting is if they like a stock and have a good understanding of it, they tend to have a really good feel for what looks like a floor or what looks like a price worth getting in at.
Okay, one last thing. This is something that I've just noticed over the years, that a lot of the people who I interview on this program are fund managers who really are momentum fund managers. You know, like Julia Lee. Julia does that. So one minute she likes something, the next minute she doesn't, and she picks up the trend. But a lot of us are long-term investors. And I think when a lot of these experts come on my program and other programs, and they all say, like for example last week, a lot of my experts were saying that they liked Altium. Well, Altium took off. And so I think a lot of those people who are trading with you are watching these sorts of programs and seeing that the fund manager has shifted from one day being into this. Like all of a sudden Julia was buying the banks a few months ago. She was never a boring buyer like that. But I think a lot of the people who are on NAB trade are learning about momentum. And if you buy the opposite of momentum, you sometimes can pick up some really good value as long as you're a long-term waiter or you're a very patient investor.
Yeah, we have a bit of everything, right? So we look at our base and understand your self-managed super funds, they're not momentum investors, right? That's not what they're trying to do. They're trying to generate a yield, which is why Fortescue is so popular, because suddenly the miners are where you get your dividends from. But it's quite fascinating how some of our groups will look for yield, and they're not fussed about anything else. They're happy to wear the volatility. And we've got others who just want trading opportunities. It's quite interesting, the different groups, but they're all quite good at knowing their niche, and that's what they stick to.
Gemma Dale, thanks for joining us.
Thanks so much.
Well, we are always trying to look for really good returns, but some people want safe returns. They like 5% returns like you used to get on term deposits in the good old days. And so I've got Paul Rickard to talk about some alternative ways in which you can get reasonably good returns, not necessarily going for term deposits because they're never going to give you those returns in a long, long time. Paul?
Yeah, look, I've got a few that could deliver a 5% income return, Peter. They're reasonably well diversified, but they do have exposures in different assets, and I'll go through those in a sec. I think we should just warn people, of course, that whenever you're looking for a higher return, there always is more risk involved. That's why term deposits are about 0.3 or 0.4 if you're lucky, right? Because they're sort of riskless.
Well, the government guarantee up to 250,000.
And anything that's promising or forecasting a higher return means more risk. So that's the first thing. And risk, I think, also is not just the prospect of capital loss. Risk also means more volatility. That is, the price goes up and down. And we saw that in the coronavirus crash when people had listed investments suddenly. Saw
what in the hell's going on here?
Saw the price of some of the investments going is pretty crazy. But also risk can mean underperformance. So you can find a fund that is promising a high level of income, but it may actually not keep up with the rest of the market in terms of a capital sense if it's all focused on income. So you get it quite badly underperform in a total return sense. So I think there's also a risk part there. So let's have a look at 3 suggestions, Peter. Two in shares and one in the bond market. The one I think is probably the most interesting and most reliable is the Vanguard Australian Shares High Yield ETF. That trades under the ticker code of VHY. That's from Vanguard, one of the biggest managers in the world. It's an ETF that invests in companies with higher forecast dividends. So they go through, scan all the companies, look at all the analyst reports, work out the companies that have the higher forecast dividends. It puts in some controls around diversification, so it has some industry limits and also company exposure limits. Otherwise, you'd just go for one company and you'd be all 100% in banking or 100% in resources. So you've got to make sure you get some sort of level of diversification. Ends up with an index of about 63 stocks. Has a current forecast dividend yield of about 4.3%. That's almost fully franked, so that grosses up to almost 6%. So for someone in pension phase or retiree or someone who's not paying any tax, that's the effective return, almost 6%.
For a non-retiree, what's the gross up factor?
The gross up factor is the same, but you will pay some amount of tax.
So in net terms, it's a bit less.
In net terms, so still pretty attractive. On the screen, you can see the graph over the last 5 years. Peter, see the big fall during the coronavirus, and we can look at that's part of the risk. But over 5 years, that's in front. So it's done pretty well from a performance point of view.
Yeah. Okay. Let's go to another one, Paul.
Yeah. A second one is from the one of the biggest managers of listed investment companies. That's the Australian Foundation Investment Group. They have their flagship AFIC listed investment company. All they originally was spun out of JB Were. It was actually the investment management part of the whole JB Were group. Yeah. But there's another one that's been around almost as long called Dejawara, right? And for years, this listed investment company was trading at a premium to net tangible asset value. In other words, where it was trading on the ASX was a higher price than what it was actually worth, right?
Yep.
Now, it's actually gone into a discount of about 9%. It's about an $800 million listed investment company aiming to pay a high level of dividends and provide capital growth. And to do that, it sort of invests in the leading companies, which is pretty normal, but it also tries to enhance that income by writing call options. And that's where some of the risk comes in for.
It makes it more risky, but potentially can give more returns, but it also can have bigger losses.
It's right. Now, it's sort of come off the boil a bit. It had a couple of fairly lean years, and that's why the premium went to a discount. But it's actually sort of looks like it's got its runs back on the board the last 12 months or so. You can see the share price has gone up there, not back to where it was at the highs 5 years ago, and that's mainly this premium to discount. Yeah. But it's providing a pretty good income return for investors.
If they can close that discount, that could be capital gain for anyone who invests in it too.
Absolutely. I mean, I would have thought this is a company that should be trading around par. In other words, shouldn't have a discount or a premium, and should be able to deliver on what it says. And I think that's an opportunity for investors in this listed investment company.
Okay, the final one, which is not in the stock market, but in fact in the bond market.
It's in the bond market now. The actual trust is listed on the ASX, trades under the code of NBI. It invests in a portfolio. This is the NB Global Corporate Income Trust, NB standing for Neuberger Berman, who are the actual manager.
New Yorkers,
and they manage a huge lot of assets that invest in what they call global high-yield bonds. Now, these are from large liquid global companies. They're diversified by industry, geography and issuer, but the credit quality is below investment grade. So this is where you're starting to take on quite a bit of credit risk. Yeah. Now, it is very well diversified, somewhere between 250 and 350 bonds. So no single event can actually cause too many issues for it, but it is exposed to credit spreads.
Of course, if a single event happens to be the coronavirus, then all those companies are affected. But we saw it has bounced back.
Yeah, and we saw that exactly during the coronavirus crash. Now, it targets a 4.5% return, but on the current ASX price, with a bit of a discount to NTA, it's yielding over 5%. They've just actually recently upped their guidance to say they're going to deliver ahead of forecast for this year. The manager, despite it being below investment grade, puts a lot of emphasis on what they describe as credit quality in their processes. Yeah. And they argue that they've had, over the years they've been running this, the defaults are just in a handful of defaults. So I think a really interesting, higher risk, but a really interesting way to get some exposure to the fixed income market.
And you've got a couple of others as well. I want a couple of others because you can mention
just find out. This is not an exhaustive list. Switzer Dividend Growth Fund, Peter. E-Invest Income Generator under the code EIGA. That's fairly similar to in a way to the Switzer Dividend Growth Fund. Both sort of we're almost sort of saying what we could describe as sensible blue chip investing. We look for companies with higher dividend yields and it can grow those dividends each year. And finally, the Qualitas Real Estate Income Fund. That's a little higher risk and a higher return. That trades under the code of QRI.
And Paul, I guess if someone was a really cautious investor, they would probably put together 6 or even 7, even 8 different income funds on the idea that some will do really well, some might just track the market. But by having that diversification, it's like being diversified with stocks.
Yeah, just as we talk about diversifying by stocks, so you don't have all your eggs in the one basket. We talk about diversifying by asset class. I think when you get to something like this, you should also diversify by managers. So take out some of the manager risk. Sometimes horrible things happen, right? Managers lose their whole investment teams or whatever it is, and you look for a bit of diversification amongst managers as well.
Okay.
These are all managed investments, but it's one way to get a fairly diversified exposure, and I think will give you an income return of 5%, but with a little bit of risk.
Yeah, and we should point out that Paul wrote a story about this on Switzer Daily only today. If you want to continuously multiply your wealth with insights from Australia's leading investment experts, then you're in luck. My team and I have put together an exclusive deal for you, our valued YouTube audience, to expedite your wealth building journey. Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer or click on the link in the description below.